Welcome everybody on the Twitter space. Welcome everybody on the Twitter space. We'll just get started in a minute here. Just firing up the Zoom. If you would like to join for the Zoom slides, the link is available on the last news release that Prospera put out here a couple days ago. Okay, I think everybody's in here now on the Zoom. So welcome to another conference call here, our regular cadence of the Prospera Energy monthly conference call that we're on, our fifth edition now, and just keep on adding more and more content to this. The last one we had was more of a technical review and a macro outlook discussion. This one we will share some of the more technical info as well as some of the community involvement initiatives and obviously, with the change in oil price, the major increase in netback and what we're doing with that netback, sort of the corporate strategy that Chris will be discussing, along with the operational and financial results for April as well. Obviously, investors are aware that our Q4 year-end audited financials came out at the end of April. The Q1 financials are set to be out here very, very shortly. Along with that, a corporate deck update and the Q-Wells report update as well will be out. Both of those documents will be available on the website. The April versions are currently online, but will be updated shortly after this conference call about the May versions. Keep going, and also a lot of good information being shared on our LinkedIn page, along with my personal LinkedIn page. So I suggest investors have a look at that for some of the latest sort of non-material updates that are coming out. Um, I just got a message that my mic is muted. Sean, can you confirm?
No, I can hear you on my end here, Shabam.
Okay. Okay, sounds good. Yeah, so this conference call is being recorded as well. It will be available on our YouTube here after the fact. And also the Twitter space is being recorded. Anybody on the Twitter space, once again, that would like to join for the Zoom slides, the conference call link is in our last news release. As per all the previous presentations, the presentation here will contain forward-looking statements. So please keep that in mind here as we continue through this presentation. And we will begin with a similar agenda as last month's presentation, the case for oil, and then the case for Prospera, why the world's most critical commodity is entering a structural supply crisis. One could argue we're already in this structural supply crisis, and why investors need exposure now. Well, the main topic at hand, the Iran-Hormuz crisis. We are now at day 83 of this disruption. There doesn't seem to be any durable resolution on hand here beyond the simple tweet wars that are going on online. Nothing material here has come to fruition over the last almost 12 weeks now, and it just continues to get more and more escalation here with no end in sight. There is certain tanker traffic going through the Strait of Hormuz, but nothing anywhere close to where it was. 20% of global oil supply continues to remain at risk, with about 15% currently offline. And the standoff simply continues. There is more and more volatility, and every day that goes by, more and more inventories are being drained, which then results in oh, whoops which then results in more and more time taken for those inventory buffers to come back to light after the war ends, which again, we have no clue at current time when it's going to. The June contract closed at a very, very healthy 107 plus dollars a barrel. And the July contract is now trading on WTI still above $100 a barrel and continues. At the baseline of this structural bull market is the US shale peak phenomenon that is going on. We have 2026 year-end US production modeled at 13.5 million barrels a day, down from 13.6 million barrels per day in 2025. The average Permian break-even, as per the Dallas Fed survey, continues to rise higher and higher as both inventory degrades, the number of water barrels coming for every oil barrel increases, the gas takeaway capacity is maxed out, and there's just less and less high quality drilling locations available that don't have parent-child interference and pressure depletion already expecting the US peak here that we currently are at. Today, you can look at the chart on the left here, Texas crude oil production, the ramp from 2012 to 2015 or so, the 2018 to 2020 absolute surge in production as US private equity backed companies kept rising. And of course, the bigger major players also kept increasing barrels. And then the slow recovery after COVID, followed by the steady number here over the last now almost 2 years and looking to either stabilize here or actually start to drop as both the Eagleford and the Midland Basin in the Permian have achieved their peak a couple of years ago. On the right hand here, we see the global oil and gas capital expenditures by Woodmac. You can see here a ramping phase from '05 to 2014, especially with the price of oil being slightly higher between 2010 and 2014. And then just a complete drop off. So we've had all this capital area under the curve has been missed. These are missed exploration, missed discoveries, missed fields that were going to be developed. I remind investors this is not a video game where we put money in today and the barrel comes up today. Some of these are multi-year projects, in some cases multi-decade projects to get these barrels of oil online. And it will take time in this higher oil price environment to have that dollar really hit the ground, develop the project, and then take it to first oil, and then back to full production. At the same time, because of the advent of US unconventional shale, global decline rates are a lot higher than they were in this 2010 to 14 range, meaning even more investment will be required in new resource that is to come here over the next 20, 30, 40 years. At the same time, some of the supply buffers that we had in 2022, for example, to mute the Russian issue, at which time there wasn't even supply hit at that time. Now we have true supply disruption. You can see the US petroleum reserve was drained by almost 300 million barrels at that time. And a small growth phase of about 50 million barrels, and now an absolute record pace. Last week was the highest SPR, Strategic Petroleum Reserve, US crude draw ever in the US. And the SPR now sits 352 million barrels below its peak and continues to drop at a record pace. So um, not enough supply buffer left here as we go and continues to get drained, which just leads to a stronger structural bull market in the future. And on the other side, the big consumption areas of the world, Japan, South Korea, Taiwan, having their inventories drop and then stabilize at what we effectively will call operational minimums or tank bottoms. Again, I remind investors, just because there's a barrel in the tank doesn't mean it can be accessed. In a lot of cases, these barrels are operational minimums required, whether they're in pipeline, whether they're in refinery tanks, whether they're in storage. These are the minimums required to run the system, if you will, that get captured in these inventories. And we had a very, very fast drawdown. The light blue here is a 5-year range. The purple is 2025, which you can see was already running at the bottom of the 5-year ranges. And then now we've had even bigger draws to basically all-time lows here. Which brings us to Canada, the Canadian oil, the safe haven with zero exposure to the Strait of Hormuz, about 5 million barrels a day of Canadian production currently, and the transbound expansion adding export capacity to the West Coast, giving us additional ability to export barrels outside the US, and a very, very strong WCS differential here that we've seen over the last 2 years since Enbridge Line 3 and transbound expansion came online. At the same time, these assets are low risk, lower decline. They're very capital efficient. There's multi-decade inventories. I remind investors that Prospera has hedged 300 barrels a day of production at US minus 1240 a barrel, a hedge that is significantly in the money here. So kudos to the team on going ahead with that. Also shows the prudence of the company on operating within safe risk reward metrics as we continue to rebuild the company here. As we go on the right side here, we see the Canadian crude inventory chart. We're sitting at a low on our 5 year range and looking really, really solid here for this to continue drawing and stay at operational minimums, which should lead to just stronger differentials throughout the summertime, despite some increase in Canadian oil barrels. The US and the world are just sucking up every barrel that we can produce here. Um, Especially given the heavy oil barrels that we have are needed globally now because a lot of refineries are set to run on that heavy oil, and the Iraqi disruption, the Iraqi disruption is still going on right now. Um, Investment thesis, in five short synopses here. Supply is structurally broken. We have US shale peaking. We have Hormuz closed. We have Venezuela and Russia constrained, which means we have the tightest supply here since the 1970s, currently in the market. Oops. Demand is resilient. You can see here on the right side, the world energy consumption by type, it just continues to go up. Um, just give me 1 second. And just every single piece of the energy consumption just continues to go up. The supply is additive, not substitutive, as the world may have believed for the last 10 years. Um, it continues to just grow. Every single piece, oil, coal, natural gas, nuclear. You can see wind and solar starting to peak out there, but just continuing to rise still as we go. Number three is that there's no buffer left. We are about 48% off our 2010 peak on the SPR, the US SPR. The no IEA release could ever offset a 16 million barrel per day disruption, and our buffer is effectively gone and being drained as we go here. Now, the price floor is rising. Permian break-evens need higher pricing to be profitable. They also need hard pricing for them to simply blow through their remaining inventory. They're not willing to do it for 10, 20, 30% IRRs. They want to see higher IRRs to make it happen. The lower for longer cycle is dead. And then Canada is a safe haven. This is really the big piece here. It's one of the only countries globally where an investor can safely invest knowing there's no wars, drone attacks, any kinds of BS and nonsense happening. Yes, there's regulatory risk, and there's political risk, and that's more than taken into account in the valuations of these companies, which in certain cases trade at a third of the US valuations currently. And then we get to the case for Prospera. Um, we have our hard sale pool, which has grown about 40% since the beginning of the year. This is a pool that had suffered from significant winter activity, not because of any type of freeze-off issues, but more so wells that we just couldn't get back to, couldn't spend the money during the tough January and February that we had with $57, $58 oil, and just weren't able to get back to those wells. The pipeline project that we did in um, November, December of 2025 has now started to really kick on. We added some injection barrels where we took water from loose land production and shipped it over to Hearts Hill. And you can see here now looking really strong here in this 24, 25 cubes a day range. We have a couple more rod jobs going on right now um, as we speak, which will continue to add barrels here in Hearts Hill. Loose land, an absolute behemoth, our main growth engine of the company. Very proud of the team and the work that's been done here. This is the investment thesis for the company. The field operations team has done a phenomenal job throughout the winter, even as the winter dragged on in April, keeping production relatively flat, and now back up to this 40 cubes a day range, set to rise now as the service rig shows up and continues to add more barrels. Some of our existing wells have really added a lot of barrels. Again, investors can find this granular data in the key wells report that is on the website here. Yeah, where you can download state-of-the-art data as we go. And again, that will be updated here after the presentation. Cuthbert Pool struggling a bit here ever since we had the VFD issue in January, February. That VFD part was replaced, but we have definitely had to be careful here with that VFD. The service rig is now active, as was news released a couple of days ago, and you can see that initial growth spurt out of that back up to that 44, 46 cubes a day range, and we'll expect to get this back up to that 60 cubes a day steady range here. really just providing additional torque to the company without spending too much money. Um, Given that a lot of this is just the pool coming back online, rather than us necessarily spending money on that recovery. The decline rates don't look like this. This is a reservoir issue that we are managing as we go, and as you can see, we've had slightly more stability here as we go compared to this constant power issue pattern that we had when the new management board first came in October of 2024. And with that, I will pass it to Chris here. I believe who you will be sharing your own screen there, Chris.
Thanks, Siobhan. Let me get some slides up here. Just 2 seconds. So what we've noticed over the past few conference calls, we have quite a few new folks that are starting to pay attention to the story and have reached out and asked questions about the assets and things. So we'll do just a quick reset first on the company's assets, a little bit about the Prospera story, how we got here, and then we'll get into what I want to talk about is really the impact that we're seeing from a pricing standpoint and what that means for Prospera's revenue and field netbacks and so on. But taking a little bit of a step back, the Prospera story and where we've been, what we've done, and the three things that the company is focusing on in terms of previous financial raises and where it's deploying its capital. And this a lot of this information is also available on the website. So I direct folks to the Prospera Energy website to have a further look into some of these assets. But the legacy is that Prospera is a Calgary-based heavy oil producer. But the story really is about the 400 million barrels of original oil in place. There's only 80% recover, and so there's a significant amount of reserves associated with the company and reserve life index on a go-forward basis. This company is really setting up for the long term, increase its production, optimize its cash flow and reserve value going forward. But there has been some efforts that have been put forth in terms of turning the company around and improving the balance sheet. And you'll hear me talk about that throughout the presentation here. But it's really about the next chapter. The subsurface is there. The thesis is proven. The strategy around the reactivations are working. We've seen the loose land graph earlier that Siobhan showed. And so, these are really the benefits. And that coupled up as a heavy oil producer, coupled up in a higher commodity pricing environment really allows us to start to leverage the amount of reserves in place. So what we're actively solving is efficiently increasing production and cash flow. Re-rate with the re-rate to pricing, we also see a re-rate on the equity side as a result of that additional cash flow. We're actively dealing with the debt on the balance sheet, and you can see that in some of the press releases where we've talked about conversion of debt over to the equity stack, where we're actively looking to reduce the impact of interest on the cash flow statement. And then we'll see a slide later on about reducing accounts payable and clearing these out so that we're resetting the balance sheet from a payable and liquidity standpoint. The three core properties, the loose land asset, the Cuthbert asset, and the Harts Hill asset, all located in Saskatchewan. These are the significant reserve assets that I was referring to earlier. Loose land is the growth engine. So this is where we see significant amount of capital going into on a go-forward basis. There's 140 reactivation candidates that we have in the queue, and we're looking to bring this field back online. And you can see the longevity of it with the 282 million barrels in place. This is a lower Mississippian back in sand at the subcrop edge. Great Darcy permeability. It's a 12-degree API heavy oil. And you can see some of the rest of the information on the 2P and the reserves in place and NPV10. Cuthbert is the low decline water flood. So this is the asset that's currently providing significant amount of cash to the organization, over 50 million barrels in place, and this is a lower Cretaceous basal manville play. The Harts Hill asset that was referenced earlier, again, another low decline water flood. This is a Bakken Sparky play, 42 million original oil in place. And you can, Shabab spoke about the increased production that we're seeing from this asset earlier in the presentation. So these are the three assets the company continues to focus on, all located in Saskatchewan, and will continue to focus on going forward. Some of the strategies that have already been delivered on. So the loose land assets, so we've already completed an 18 well reactivation program. There's been a 300% increase in production growth. And as I mentioned, 140 reactivation candidates left to go. So lots of running room for this asset on a go-forward basis. Continues to be the growth engine. These are all CHOPS wells. Single well battery startups with full winterization on the reactivation wells. So we're not only going in, getting these wells online, we're thinking about the next winter that comes up and realize significantly higher uptime over the past winter as a result of some of these capital deployments in 2025. So this purpose-built sand control suspension chemical, undersized rotors, recycle pumps, suspension chemicals are all part of the secret sauce that the company's been employing to be able to ensure that these wells, after they're worked over, are up and running and stay up and running, and we're able to keep the service rig away and ensure that there's positive economics associated and positive near-term paybacks associated with these wells. The forward plan is to continue to do more of this. So continue to bring more of these wells online, continue to pour capital into this, but also to optimize this and ensure that perhaps even getting a little bit more aggressive in some of the production profiles here. We're having to take it very slow, ensure that we're not pulling too much sand at any given time, and ensure that, as I mentioned earlier, ensure these wells stay online. The Cuthbert asset, the low decline water flood, there's been a significant amount of injection optimization and work associated with the water plant, and will continue to be going forward. We had some success on some heel perfs with some of the horizontal wells that were drilled in 2023 that were producing a significant amount of water. So we've been able to block off a lot of the water and perforate the heel portion of those wells, which has added a considerable amount of oil production on some of those wells. As some of you may be aware, there were 2 water injection pipeline replacements completed last year. And this has allowed our operations team the ability to put water away. We've invested in new engines, hydraulic skids, flow line valves, and then winterization on this asset as well. So another key contributor to the long-term success of the company. There will be additional focus on the water plant going forward, and continued water flood optimization, as well as reactivations and workovers on existing wells to bring on additional production. And we've been working closely with some of our key stakeholders to reduce grid-driven downtime, ensure that we've got, because when these water floods, we want to make sure that they're up. Uptime is very key. When they go down, it doesn't just take a day or two to bring these wells back online, but we see a longer term impact as a result. So we want to ensure uptime is monitored closely. Harts Hill, low decline water flood as well. Seeing some good progress on this over the last few months. There was 1 injection pipeline replaced last year. We'll be looking at another injection pipeline replacement this year. We've got multiple workover candidates identified across the field. There's a very modern central processing facility, so that the asset has the ability to scale further. There was some 3D seismic reinterpretation looked at earlier this year as well. The water flood plan, or sorry, the forward plan, as I mentioned, water injection stimulations, and another pipeline replacement, water flood optimization, targeting new patterns. and continued spark and Waseca pool development within the asset. Okay, I talked earlier about the balance sheet optimization, balance sheet transformation that continues, with considerable progress in Q1 and on a year-to-date basis. For 2026, there were 98 creditor agreements that were signed, where we're working closely with legacy arrears or critical vendors, and looking to reduce the accounts payable burden on the company. So in Q1, 98 creditor agreements, approximately $2 million of AP was settled, and so you'll expect to see a reduction in the accounts payable from Q4 2025 accounts payable balances to Q1, and you can see that a lot of these settlement agreements have already been announced to the market, and a lot of the shares for debt settlements have already been completed. Also, some AP forgiveness through these discussions as well, but this is really part of the overall strategy to improve the liquidity of the company, to improve on the working capital deficit as we continue to work through this higher commodity price environment. Slide's really important here for what we're seeing on a profitability basis and on a net back basis. There's a lot of information in here, and I'll just kind of speak to the high level pieces of it. I wanted to focus on what life looks like post Hormuz closing. And as you can see, from March through May, we're seeing considerable increase on a net back basis, and this is part of the leverage associated with a heavy oil producer, that we've seen net backs move from an environment where we've seen $5 to $10 net backs to $30 to $40 net backs, and so there's been a considerable improvement. A lot of the costs associated with Prospera's operating costs have been and are fixed, so property taxes, operators, surface leases, and so on. And so when we see a price increase, as we've seen over the past 3 months, we're not seeing the same increase in variable costs. So our cost profile is staying flat. Yes, royalties are price sensitive and based on revenues, but from a netback standpoint, you can see the increase that we're realizing. And so that really starts to boil down, or where the rubber hits the road here is in cash that we're seeing on a month-to-month basis. And so from sales being in the 1.3 to 1.4 range, where per month we're seeing sales of 1.9 in March and April, increasing to 2.4 million a month in May. And so that now coupled up with volumes that are coming online from the service rig that's currently active in the field, that's bringing on additional volume, we're seeing revenue increasing not only by price but also by volume as well. So happy to take questions and discuss this further at the end of the presentation. And here's really just a little bit more of a visual associated with this. And so we're seeing relatively flat netbacks in the pre-Hormuz scenario in January, February, and you can see the increase March, April, May that I was talking about earlier. You can see the increase in sales on a per BOE basis. And then over on the right-hand side, a little bit more of a table, sales, realization in terms of on a per barrel basis, and then on a field netback basis and a net operating basis as well. And so, March and April, we were seeing net operations in excess of 600,000, May increasing considerably as a result of this higher price environment as well. This slide here really just speaking to the shock that we're seeing on the pricing side of things. So the Straits closed. We're seeing 14 million barrels off market. Maybe that number's a little bit lower with some of the barrels that the Saudis and others have been able to get to market. Slow reopening. But nothing significant. And so a large portion of this is still offline. And so we're seeing this re-rate from $60 oil to $100 oil in 90 days, with a WCS to WTI differential that's largely flat at 13 to 15 dollars a barrel. Prospera has been able to hedge some of its differential just to ensure if there was a widening of that item that there would be some control. So we've got some hedges in place in the $12 to $13 range. But what this means is that we're seeing a 60% increase in price, from $60 to $98. And, of course, there's things that are jumping around considerably even today. We're seeing the largest draw in U.S. inventory in history of about 17.8 million barrels. And then there's some contra news, tweets coming out about potential settlement with the Iranians, but there's certainly some choppiness to what's happening here. But we expect that this situation is not going to be solved overnight. And if we start to look at this, and this is pricing information from yesterday, by the way, so I think there's about $5 or $6 that has come off the WTI price today. But we're seeing a June contract of about $108 WTI, and then some backwardation in those numbers as we move towards the end of December. But pricing that's probably still in the $79, $80 at the end of the year, which certainly supports strong revenue and cash generation and operating netback for the company here as we move forward. Yeah, and so just I think in closing here to kind of come back to it here, Q1 set the floor a little bit. We've seen some low pricing environment. We were operating very lean, very conservative. Even in Q4 of last year, that continued in Q1 of 2026. But now we're seeing this expansion of pricing, and what's really a bit of a breakout here. So Q2 is expected to be about 58% higher than Q1. Those Q1 results will be published, I believe, next week to the market, and we'll put that information out on SEDAR, and of course the press release that information. But looking at a full year 2026 of 90 plus realized Canadian dollars per barrel, which continues to be very optimistic price environment and cash flow and revenue environment for the company. So Shabam, I think maybe I'll just keep sharing the presentation and I'll let you take over from here on some of the different items and pieces that Prospera has been involved in.
Yeah, I'll just yeah, let's take back that presentation if you don't mind. I think my screen is being shared there. Chris, if you just want to mute yourself, I think we should be good to go there. So yeah, thank you for that really detailed update there. I think very, very exciting times for us as a company. It was definitely a grind throughout 2025. Lots of operational success, lots of strategic success on the loose land reactivations. However, at $60, $65 oil, just still a grind every single day to get through. And we have got through to now where prices have just risen incredibly since then. And again, as we mentioned, no de-escalation in sight here, and some really strong pricing towards the end of the year, it looks like, as we speak right now, with our service rig active as well now in the Cuthbert area. as was news released, and looking to run that rig steady throughout the summer with, as was also previously mentioned to the market, a second service rig on deck here for the loose land reactivations. We've got 41 tier one reactivations that we'd like to get to this year, along with the recycle pump strategy on some of the legacy wells, just to continue adding barrels and actually get the company to a place where, multi-millions of revenue a month and then into the seven figures of net operating cash flow per month, which we've got our line of sight on here as we go. So one of the big initiatives that's been taken on by the corporation here is that AI dashboard initiative. This is something that is very much in progress. The company has built about 20 different dashboards across its organization to track our oil production, our capital program, AP tracker, different kinds of well profitability, and then the workovers and AFE tracker, surface landowners as well. So really consolidating the company's base SharePoint and all kinds of data sources into one area where it can be easily visualized and then used to generate insights and where our time is best spent from an engineering team standpoint and the financial team standpoint. So very excited to share that this is something that's an active progress here as we go, and a investor-facing version of this will be released in the near future. So investors will have state-of-the-art access to some of the key wells reports, but more in real time even, as we continue to go on our goal towards ruthless transparency and just providing the most up-to-date information for the investor base as possible. Some of you have been with us for multiple years now, and I think deserve a more updated information than um, quarterly reports that can be several weeks or months behind that actual activity occurring. So we're excited for this initiative. It's given us great insights already, and it's still very much a work in progress, as we continue to build this out. We also want to share some of the interesting things we've been doing in the Calgary space. It's not just Prospera, a heavy oil company. We are very active sharing what we're doing, providing insights to the general public in the Calgary area, technical insights on our differentiated strategy. We are one of the only junior companies left in the sector of our size in the sub 1,000 barrels per day range. And I think it's important that we go out and share. This is a picture from the Saudi Petroleum Engineers presentation that we did about 8 weeks ago now. As you can see, a full house of technical experts and engineers that attended this, talking about the PCP pump strategy that we had. We also presented at the Artificial Lift Canada 2026, talking about our PCP and recycle pump strategy, and then a panel discussion on unconventional and conventional production engineering metrics. So very interesting discussion talking about the price of oil, how that impacts our production strategy, and on stage here with some very interesting individuals from Weatherford and some other international E&Ps. Great discussion was had here. We also supported the entrepreneurial community in the oil and gas space with Oren Ventures in town. So participated as a judge in this competition and just learning more about the latest technologies. One of the things that investors will know is that Calgary is quite behind in terms of adapting new technologies and some of the latest innovations in town. And so we want to be at the core of that. We'll share more details on this sort of as we go on. Also supported our rural landowners with a welcome address at the Illuminate Champions for Change in Vancouver, where we talked about the relationships we're making with our certain landowners. Myself going to the field every 3 weeks, our chief operating officer being in the field, and of course our field operations team that is day in, day out, supporting the community as we rebuild Prospera and then just keep building this to be an absolute behemoth of not just production but cash flow, providing that jobs, revenue, economy impact for decades to come from here on out. We will also be featured in the Energy Ear, which is a publication that for the first time is returning to Canada in, I want to say, 12 years, as they've identified that the energy markets in Canada are finally open. Investors are very interested in coming back now, not just with the Strait of Hormuz crisis, but even before that, identified as a place where growth can occur. You had undertapped, undercapitalized assets, a very, very influential magazine here. More information on this was shared in the latest news release that came out on Monday morning here as well. and investors can check them out on LinkedIn for their other copies as well. Also, very proud to share that we will be part of a panel discussion at the Global Energy Show. This is one of the biggest shows in Alberta, with 30,000 viewers coming in over the 3 day period. And we will be presenting on unlocking new potential, revitalizing Canada's mature fields, with the president and CEO of the Petroleum Technology Alliance Canada as the moderator of this panel. So very, very excited, not just for the company we're building and the leaders we're building within the organization, but actually getting that industry influence. Despite our very small size in a country that produces 5 million barrels per day, we're at roughly 800 barrels per day, but we are speaking with and alongside some of the biggest heavy hitters in the area. So very excited to see how this scales here as we go, especially with our transparent way of bringing junior oil back to the investors. Not everything we do is a success. We're not hitting it out of the park every single day, but the general trend is up and to the right as we fix some of the legacy problems, continue to prove out our strategy, and just continue to move forward on this business plan, which is obviously a lot easier in a $100 oil environment that we currently sit in. We will also be now presenting globally in Houston about Orphan and Idle Wells 2026. This is a conference in south of Houston in June 24th, 25th, discussing how reactivating idle heavy oil wells can create sustainable value creation. So this is a part of the industry that has been left for dead for many, many, many years, with bigger companies focused on the SAGD plays, on the multilateral drilling and the unconventional shale frac plays. These older wells that have huge potential have been just left here idle. And so very excited to share what Prospera is doing and how that strategy can then be sort of scaled up as we go. I remind investors we have 140 wells within our own back pocket already that Prospera owns, and planning to bring online here as we continue to roll ahead. Also very proud to support the University of Alberta with a Prospera Award in Petroleum Engineering. This is something that is very important for us to have a pipeline of strong engineers, and more entrepreneurial engineers that are focused on coming into our industry, again, focused on heavy oil, bringing individuals back to support this older well, legacy well resurgence that Prospera is focused on. So very happy to see this relationship continue to go as we continue on over the next few years, building out Prospera to be an absolute top of the line company in this space. And with that, I also remind investors that our 2026 AGM has now been finalized. It will be June 17th at 11 a.m. Mountain Time, in the same room it was last year in the Calgary Petroleum Club, the trophy room. Investors are asked to either reach out to register or show up. Your name will be on the list there to attend, where we will be sharing further information. Our entire board will be present there in person to mingle and share further insights. And happy to answer any further questions in person there as well. Any investors that would like to come in, please feel free to reach out or register directly online through our website there. And with that, we are going to wrap up this presentation. It's been a pleasure here to have the fifth iteration of this conference call. We're going to continue on next month with the next conference call, likely right before the AGM, so investors can come in fully informed as to the latest happenings of the corporation at that time. My email, Chris's email, and our website here is available as well. And once again, the recording for this will be on YouTube. The Twitter Space recording will be recorded as it usually does. And we're very excited to build here, continue to build through this higher oil price environment. We support and very much appreciate the investors that have supported us through the last 18 months of this rebuild. It has not been easy, but we have had tremendous success, small wins every single day, and just continue to push against that wall. Of course, with higher revenues now, net positive cash flow of the corporation that's starting to reach some really meaningful numbers. And of course, some very interesting strategic partnerships that are coming to light after all the seeds that have been planted throughout 2025. The story was shared through hundreds of parties, through our LinkedIn, through our Twitter, and now some of those have been coming back, looking to explore additional strategic alignment, both on the production end, on the field end, on the service rig end, on additional capital partners. And so very excited to yeah, just continue building. Maybe I'll pass it to you, Sean, here for questions, and then we'll finish up with some closing words and yeah, go on our way.
Yeah, thanks, Shabam. A few questions trickling in here. We'll start with when the company's doing these professional presentations to peers, what type of feedback are we getting?
Yeah, I can take that one. I think the general feedback is of energy. So the peers that we have in our group, some of them are working for bigger companies. Some of them have been shunned over the years to not go out and speak, publicly about anything, kind of keep everything in house. And I think the industry is happy that there is individuals and companies willing to put ourselves out there. We're not going to bat 100% all the time, but we're willing to put ourselves out there and share the story, share some of the resilience that we're going through, share the hard work and the successes and the failures of what's happening. So we've got really strong traction. Numerous individuals stay behind after the presentation for an extra hour or so to come in, chat with us. And many of them, Chris and I end up actually meeting with for either coffee or lunch after the fact, especially capital partners or sort of those that are higher up in some of our heavy oil peers. So it's been a great network building and relationship building opportunity. We continue to get more invites than what we can do while running the base business as well. So I think this strategy slash sharing is just going to continue to increase as we go. We as part of the board of directors here own a large portion of the company, so we have our money where our mouth is. This is not I'm happy just sitting here doing my work day in day out. Like we believe in this. We're going to just keep hammering away at what we're doing, and we're very excited to be part of this community that there's been a lot of tough hits that this industry's taken over the last 12 years. And I think it's important to bring some of that energy and positivity back, not just this sort of jadedness of, well, everything's just gonna go down anyways. I think we need to enjoy the times when it's higher, take advantage of them, reallocate that cash properly, and then just sort of continue building these companies. The junior oil market in Alberta, Saskatchewan has been decimated over the last 10 years. And I think individuals and peers are happy to see that's coming back and sort of adding value. Chris, any thoughts there?
No, I would agree, Shabam. I think we are one of the last standing juniors. A lot of the existing juniors kind of ended up falling down last year, and I'm certainly happy to see pricing breakout, which has helped us through this as well, and that low commodity price environment has led to a lot of the settlements and things like that we had to do to preserve the company. And I see there's a few more questions in the Q&A about whether we're gonna continue to work through these shares for debt settlements, and that's a question that we're actively discussing amongst the management team and the board, because on a longer term basis with this higher cash flow, we want to pay down the debt. We want to settle the AEP rather than issuing more shares and further diluting the company. And so, that's an important consideration here. But at the same time, we want to balance that against the capital and the development program. So we want to continue to deploy capital in measured, staged phase, size to internally generate cash flow, rather than external funding, preserving this balance sheet flexibility, progressing the development plan. So, but at the same time, as folks are familiar, that there still is some work to do at Prospera. We've still got fairly sizable AP position on the company, and so we need to balance that against our growth plan and how we move this forward.
Thanks, Chris. Next one here, I have your earliest reactivations now have some real history behind them. Are they performing in line with your original model?
Yeah, thanks, John. I can take this one. So this has actually been one of the sort of undercover things going on in the corporation. We talk a lot about capital programs. Okay, yes, Cuthbert pipelines, Hartshill pipeline, the rig active, whatever is going on in terms of the latest reactivations that will be done this summer. Starting right away, I should say. But really, we're monitoring our existing wells very closely, not just for their sort of barrels per day, but their longevity. There's this general feel in the industry that a PCP should only last for 1 year. That's sort of the general run life of a progressive cavity pump. Wells are going to decline over time, and what you're seeing is actually the opposite. We've been able to keep wells running for multi months, in some cases now approaching 12 months. That when you look back in the workover history of that well, they were being worked over every single month. So, um, you know, it's not just a doubling or a tripling; it's a complete step change in the netbacks of these wells. I remind investors, Prospera doesn't believe in maximizing out every single well. We keep our wells running between 40 to 60% of their max capacity, and that completely reduces the workover burden on the corporation. As the company scales, as we have more production at loose land, can we push that to 70%? Could we push that to 80% on certain wells? Certainly. And so there's this hidden upside that remains in the base barrels. We don't want to push those wells too hard right now and cause sand influx problems, requiring workovers and downtime. We just want to keep the wells steady, chugging. At today's price, some of the wells are paying back every 60 days for the capital that was put in, and we're just going to keep them flat there. The other big win is just the PCP design. So we've swapped from a 5 series pumps to 8. Now a lot of our designs are 13 series pumps with 1,500-meter lift. With the recycle pump strategy, moving now as we continue on towards a smart pumping strategy. So adding more automation, adding more sensors on the wells, and everything is iterating as we go. Um, we don't necessarily need to go out and share every single thing we're doing, but investors that are watching closely will identify these step changes. Very, very happy with those wells. And I'm also quite excited because as we do the next 10, 15, 20 reactivations, they're going to come on a lot faster. They'll be able to scale a lot faster. We won't see some of them go down immediately like we did on some of the 2025 wells with 5 series pumps, 8 series pumps in there. And once we bring those next 10, 15, 20 reactivations online, the company is big enough where we can go and start pushing some of the existing wells harder, knowing that we have the cash flow and the ability to sustain one or two wells potentially going down for a small period of time without completely destroying sort of the loose land overall graph. Where we want stability to maintain that cash flow predictability. And quite excited from a production standpoint, cash flow standpoint, and also for a reserve standpoint. We didn't necessarily get the kinds of uplifts we would have wanted at our 2025 year-end reserves because we didn't have enough production history to fully convince our reserve auditor, Sproul, to give us that long extended life on these wells. So the existing more and more wells that we end up doing, the more that the reserve auditor sees that, the higher PDP we get, and it just sort of continues to scale from there. So, a lot of things we've had to be very, very patient, almost like a caged wolf sitting, just sort of waiting to launch. But patience is the name of the game. The reason these pools were left was because the previous operators got impatient. They started spinning the wells too hard, and then eventually the wells went down and they walked away. And that that is absolutely not in our plan. So patience will lead to bigger rewards and just bigger and bigger reliability on these wells here as we go, which will happily prove out month after month through these conference calls and through the key wells reports.
And Shabam, that's some of the things that the dashboard is tracking is the profitability per well here, and I think this is kind of some of the cool evolutions that we've seen with this focus is we're tracking payouts on every well that we've operated since the 2024 changeover. We're looking at the most profitable wells on a monthly basis. We're looking at understanding why and what the drivers are behind that in case there's generating new learnings from from those pieces, and it's actually forcing our accounting process to be more streamlined around allocations and making sure that the wells are being properly burdened and so on when we look at it from a profitability standpoint. And this is information that would be available to investors on a go-forward basis. And I see there's a question here about when will there be a show of our new desktop software product, and I think that's something that we haven't yet announced, but we can anticipate in the near future.
Thanks, guys. These are two separate ones about the assets. Maybe I'll try to put them together. First one is, you recently hit an 8-year production high at Luseland. What is a realistic year-end 2026 target? So that's for Luseland. And then followed up is, Hearts Hill grew 30% net production year to date. Is that with reactivations, optimizations, or both?
Yeah, 100%. So the loose land growth that we will see, as was mentioned in the last answer, is not just from the reactivations. So we have a plan to do 40 to 41 reactivations this year. Investors can track some of the wells from the last key wells report. Roughly 8 to 10 barrels per day is your baseline, with some of the wells performing quite a bit more than that. And then we come back to our existing wells and also start optimizing those. So I don't want to put out a number of where we're going to be, but you can run the math and see. We want stable production. We don't want massive spikes and then 5 wells are down and it drops right off a cliff. We want to see definitely strong, reliable, just slow, steady growth as we go. So depending on where the oil price sits, depending on our cash flows, how fast we're able to accelerate that program this summer, it's still a bit of an unknown. We're being very measured in our growth. It's not like, we saw $100 oil and all of a sudden we've got 100 rigs fired up. It's going to be very measured. We are very understanding of our legacy balance sheet issues. We are continuing to work on our AP balance. We're continuing to build strong relationships with our core vendors. And some of those requires cash to go out, not into the rig program, but into sustaining or building more relationships. So I think investors will expect to see us continue to share these updates on a monthly basis, right? That's, I think, the one of the best things we have going on here for investors of Prospera, that we are available on a monthly basis. Chris and I are available in the office for any emails, texts, people stopping by the office, and we're willing to share information about what's happening through our LinkedIn as well. You can see the progress between the conference calls on where the rig has been active, how many wells have been done, and then it's relatively easy to run the numbers on, okay, this is the pace they're going at, and then get an update every month, thereafter. So I think that's the model that we're going to run here as a company going forward. Year end, we don't want to put out guidance here. We're going to just keep putting out good information from there on out. And then as far as Hearts Hill goes, a lot of the barrels we've seen have been without any capital spent. So yes, we've done basic flush by jobs. Yes, we've done basic rod rig jobs. But at the end of the day, we didn't even bring the rig back to Hearts Hill. That growth is from simply water flood optimization. It's for bringing extra water volume from loose land into Hearts Hill, getting some of the flood operating a bit better, because we did need more volumes to do that. Small speed ups. There's a couple wells where we switched to water injection down the well instead of oil injection like we have in loose land. Just different strategies, still understanding the reservoirs. We're a very technical, but yet also creative team. And so spending a lot of time with that, and big kudos to our field operations team that have absolutely put the pedal to the metal, sort of delivered on some of the things that investors were asking for at the beginning of the year. There was a lot of questions about Hearts Hill, and here we wanted to show that we can get the reservoir back up, that the decline rate on the pool is not 50%. It's to do with certain wells going down, which screwed up the water flood and just put injection and pressure maintenance in the wrong areas. So, I can confirm that there was no rig jobs done in Hearts Hill all year long. And I think there was one job done in March, if I'm not mistaken. But since the spring breakup has ended, we have not done any jobs, and that's where the largest increase has come. So, continuing to play around, we're operating within still an environment where we're maintaining a strong, uh, very, very close eye on our cash balance. We're not just going to go do 10 projects at the same time, even if they have really good paybacks, because cash is king. And it's important that we have enough cash to meet our other obligations in the corporation as we continue to build the company.
A couple more here. Next one. Where do you see net back per barrel heading in the next 12 to say 24 months?
Yeah, I can take that one. Very difficult to predict where pricing is going to be just with the amount of fluctuation that we're seeing currently. What we talk about though is building the company for a $60 oil environment. We lived through that over the last 6 months, 2025. We know that the company can generate positive returns through that type of environment, as long as we're really closely monitoring our costs and we have a production at the scale of greater than 800 barrels. And so, that's the environment that we have to plan for on a go-forward basis. And if we can do better than that, then great. You can look at a variety of different strip pricing and different outlooks on pricing, which are available to the general public. You can look at the forward contracts for the next 3 years. That gives us some information, but at the end of the day, we have to plan for a $60 oil environment in the event that we get back there, and that's how we have to build the company. Shabam, I don't know if you have any further thoughts on that.
Yeah, I mean, I think this is very, very important for investors to note, right? We are a company that produces heavy oil, and there is a differential there. We do have debt on the balance sheet, and there is a base amount of G&A required to run any oil company. So, I'm very proud to share that March and April were significantly free cash flow positive on a corporate level, not just on a net operating field level, but after G&A, after interest, all the obligations of the company, we were free cash flow positive, and not just a dollar or two, like significantly multi hundreds of thousands of dollars free cash flow positive. So I think that trend will just continue to rise as we find further efficiencies, and the company will continue to add barrels. Every barrel that we add is very, very high netback, just due to the state of the company. Like, we're not paying any extra field operating costs really for any extra barrel beyond transportation, and royalties, obviously, because a lot of that cost is fixed cost that's already embedded in the base organization. That's the reason we have 140 high-profile reactivations on our books. Like, those are all not producing anything and costing us money. So as we continue to scale the company from here onwards, that operating cost will get slashed down very hard, and so will the G&A and interest cost per barrel. Not because the raw numbers coming down, but because the revenue continues to scale at a much higher rate. So, and the barrels continue to scale. So the dollar per barrel impact of that starts to get reduced. And with that getting reduced, obviously the company becomes more and more cash flow positive, even at lower pricing. And that's what the last 65 to sort of 90 days have been. That's what the next multi-months are going to be. Rome wasn't built in a day. We're just going to continue to put in the hard work every single day, and that's going to deliver results in 6, 12, and 18 months.
Thanks, guys. I think there's two more here. I might put these together. First one is, please comment on the success of the pipeline replacement in Cuthbert. Has it been worth the capital costs? And then secondly, there's a question, how does Luseland, Harts Hill, and Cuthbert differ in priority for the corporation?
Yeah, I can take that to start. So the Cuthbert pipeline replacement project was exceptionally successful. Into November, December, January, we hit 65 cubes a day out of Cuthbert, relatively steady, and then we suffered from a VFD outage. So a very small resistor in this VFD failed. The part had to be brought in from Europe. and that's taken a lot of the fizz out of this reservoir. We've been monitoring very closely, changing up different casing pressures, changing up RPMs on wells to get the flood back to where it was operating. In general, Cuthbert needed assistance. This was a pool completely mismanaged at the time that the new team came in about 18 months ago, with engines that hadn't been oil changed in multiple years, and just all kinds of stuff that we had to go and spend time on. So we now feel confident in this current injection pump. Our second injection pump has ran very steadily, and our third injection pump is currently under order, uh, being built for us, custom built. So there's continually movement happening in the right direction. The rig has completed 3 wells now in Cuthbert, so that's going to add barrels. And we'd like to keep Cuthbert steady around that 55 to 65 cubes a day range. That's where we feel it's the best stable range for it. Pushing it beyond that just is not cost effective to what we're trying to do here. It's not a race for barrels, it's a race for reliability, longevity, and cash flow. So the pipeline project had to be done regardless. You can't leave pipelines that have failed in the past just in the ground. And we really needed to reroute some of that water to the south. So one of the wells that actually the rig has completed just now is part of that new pipeline install. So even though we got the pipeline install done, several of the wells that were operating within that area were not able to be brought back online because of just cash flow restrictions back in that December, January, February timeframe. So the full scope of that pipeline project is now going to be realized with the addition of the 3F28 injector, which is now back online. And we'll just continue to go from there. I think from a corporation standpoint, keep Cuthbert 55 to 65, keep loose land between 24 and 27, 28, and focus on loose land. Keep loose land going. That's where we've seen the most reliable barrels, the cheapest workovers because the water quality is so good. There's very little corrosion. We have existing infrastructure in place, and the pool is very close together in terms of these heavy oil pools. So you will continue to see us then allocate to loose land throughout the summer and get it to a place where the company becomes completely self-reliant and stable into the latter half of that rig program here as we go. So I think that's the goal of the corporation. We can move very fast. I remind investors that within 36 hours, we can get a well reactivation complete. If the rig starts at 7 a.m. on a Monday morning, by Tuesday at noon, that well is spinning. So the these are not multi-month, frac projects, blah blah blah. It's very simple. We've pre-secured important equipment that we need to do these reactivations. We've got some very, very strong field operations team and service provider team that can get these single well batteries built. As was mentioned, the company has acquired some of our own service equipment, which allows us to operate very quickly. And I think that's going to be the corporation. This corporation is a loose land story. This exceptional prolific pool that's being brought back online step by step by step, and once it gets to a place where it's making that barrels per day number, it should stay there for the next 10, 15, 20, up to 40 years, and we can prove that. So some of the previous presentations that we've made on these conference calls have shown that in detail. And I'm happy to talk through that with any investor or any engineer, and as to why that's the case. So these are multi-decade pools, and as much as it, for me, okay, well, we've been here for 18 months, we should be ahead, yes, but it's just a game of patience. It's about day-to-day execution. I keep repeating myself here, but 18 months on a 40-year oil well, it's still a little baby, and we're still working on it, kind of getting it to where it needs to be, and then it just continues to produce cash flow from there on out.
Awesome. Thanks again, Shabam. I think we can leave it there. One more quick reminder, AGM is June 17th at 11 a.m., Calgary Petroleum Club, and we'll have this on our corporate YouTube channel shortly. Appreciate everyone's time. Thank you.